For this learning objective, let's compute the margin of safety and explain its significance. The margin of safety can be calculated in terms of dollars or units. The margin of safety in dollars is simply the excess of budgeted or actual sales over our break-even level of sales. And we can express this in terms, again, dollars or units. In dollars, we'll just take total sales minus break-even sales. In units, we'll take total unit sales that we currently have minus our break-even unit sales. Let's look at the racing bicycle company and determine its margin of safety. Recall the racing bicycle company's actual sales were 500 bicycles per month for revenues of $250,000, resulting in a net operating income of $20,000. We calculate our break-even sales at 400 bicycles per month, or $200,000. Thus, the margin of safety is the difference between our current sales of $250,000 and our break-even sales of $200,000. Our margin of safety is $50,000. We can also express our margin of safety in terms of a percentage of sales, in which case for the racing bicycle company it would be 20%. That's our $50,000 safety margin divided by our current sales of $250,000. Again, our margin of safety can also be expressed in terms of units. We could calculate our units by taking our margin of safety in dollars, 50,000, and dividing it by our selling price per unit of $500, and we get 100 bikes. Alternatively, we can just compare the break-even number of units with our current level of sales on our contribution margin income statements. Current sales are 500 units and break-even sales are 400 units. So our margin of safety is 100 bicycles. Let's go ahead and work through one more example. The Molander Corporation is a distributor of sun umbrellas used at resort hotels. Data concerning the next month's budget appear below. Compute the company's margin of safety as a percentage of sales. To begin with, we're going to need to calculate our break-even net operating income. Our fixed expense we're given as $7,500. Our contribution margin per unit is $10. That's our $30 selling price minus our $20 variable cost. Our break-even net operating income is where net operating income is zero. This means we'll need a contribution margin of $7,500. If our contribution margin per unit is $10, our break-even units will be 750. That's our $7,500 contribution margin divided by $10 per unit. We can confirm this is the case by completing our contribution margin income statement. We'll take our per unit amounts and multiply it by our 750 units for break-even. For sales, we have revenues of $22,500. That's simply the $30 per unit price multiplied by 750 units. Our variable expenses are $15,000, which is our $20 variable cost per unit times 750 units. In subtracting our variable expenses from sales, we end up with a contribution margin of $7,500. Once we subtract our fixed expenses of $7,500, we indeed reach our break-even net operating income of zero. Let's go ahead now and calculate our margin of safety. Our margin of safety is the difference between our current sales, which we're told were $30,000, and our break-even sales that we calculated as $22,500. Our margin of safety then is $7,500. On a unit basis, our current sales are 1,000. Our break-even sales were 750. So break-even, or rather our safety margin in units, is 250 units. On a percentage basis, our safety margin is 25%, which can be found by taking our $7,500 safety margin and dividing it by our $30,000 sales, or simply dividing our safety margin in units of 250 by our current sales of 1,000 units.